Good morning, everyone. We're just going to give it a minute for everybody to get in, and then I'll get started. Hopefully everybody's enjoying this fall, crisp August morning. Okay, it looks like we're starting to get quite a few people in, so I guess I will just get started with our opening remarks. So good morning, everybody. Welcome to Maner Costerisan's Nonprofit Education Series. This session, we're going to talk about some of the takeaways that we, as attendees to the AICPA National Nonprofit Conference, took away from the conference, and we want to share that with everybody. So we are here to do that. So we're so glad that you're here. A few housekeeping items. The session is being recorded and everyone is muted. So if you do have questions along the way, please put them in the webinar chat, and I will be monitoring those a little bit later in the chat. We can get to those either during the session or at the end. We are offering 1.8 credits of CPE this year for this webinar. Throughout today's webinar, you will see some periodic polls pop up on the screen. Please select the circle and click Submit. To qualify for CPE, attendees must participate in at least 75% of the polls and be in the webinar for at least 50 minutes. Credits will be prorated based on the time and that you're in the webinar and the participation in polls. For participants who meet those CPE requirements, we will issue certificates via the email that you use to register for this webinar through our learning management system. If you have any issues with any of the polls or anything like that, please just chat with Rebecca in the webinar chat and she will be able to assist you. So our speakers today are myself, who is a partner in our tax department. We have Amber Rathbun, who's a senior manager in our tax department. Daugherty, who is a senior manager in our accounting and outsourced solutions. And then Kyle Schafer, who is a partner in our audit department. With that, I'm going to go ahead and share my screen and get started on my part. Okay, hopefully everybody can see that. I'm going to go ahead and get started. So today I'm just going to talk about some hot topics, tax mostly related for exempt organizations. So I'm going to talk about a few different topics. So we're going to talk a little bit about proposed regulations for donor advised funds. We're going to do just one slide on name, image, and likeness, or as most people call it, NIL. And then we're going to get into a hot topic, which is the employee retention credits, which I really enjoy talking about. And then at the end, just some random legislative updates. So donor advised funds. So there is some proposed regulations for donor advised funds. And when I was in the conference, I did learn that there hasn't been any real regulations for donor advised funds for about 17 years. So this is a much wanted proposed regulation. So we're pretty excited about having this for those of us who work in this area to just give us some guidance on some of the things that revolve around donor advised funds, or known as a DAF. So what is a donor advised fund? A donor advised fund is a charitable giving vehicle that allows donors to make contributions to a fund, receive that immediate tax deduction, and then they can direct those grants to charities over time. It's definitely a great vehicle for someone who maybe wants to get that current deduction, donate to charities over a period of time, but not create a private foundation. So in some cases, a private foundation is used if you want to do that type of thing, but private foundations come with a lot of legalities and are a little bit more complex. So this is a great vehicle for that type of giving. It is managed by a sponsoring organization, typically a public charity. Some of the reasons for this proposed regulation is to address concerns about the delay in charitable distributions and accumulation of those funds in DAFs. It's also going to enhance transparency and accountability. And there's a little bit of information on the criteria for excise tax on taxable distributions. So there can be taxable distributions out of a DAF. In many cases, that could be, for an example, to a person or a non-charitable organization or possibly a foreign organization. if the sponsoring org does not exercise expenditure responsibility. Expenditure responsibility is could be a whole nother presentation, but you have to exercise that expenditure responsibility when distributing to someone that's not a charity. Or it could be a distribution where an interested person is receiving some sort of incidental benefit from that distribution. Some of the key provisions of this proposed regulations are some distribution requirements. So this is going to talk about some proposed rules on the timing and the amount of distributions from donor advised funds to charities. Also, some specifics on how funds must be distributed to avoid excess accumulation in that fund. Disclosure and transparency. This is going to give us enhanced reporting requirements for donor advised funds. Also, increased transparency on the management and the use of those funds by the sponsoring organization. Some investment restrictions. So we're going to have some new guidelines on the types of investments that DAFs can invest in. And also there's going to be measures in place to prevent conflicts of interest and self-dealing. With administrative costs, there's going to be some limits on the administrative cost and administrative fees that can be charged by a sponsoring organization in order to manage the donor advised fund. And also ensure that there's a significant portion of that donor advised fund being used for charitable purposes versus administrative fees. They're also going to expand some definitions of the following: donor, donor advisor, donor advised fund, and advisory privileges. And just having these expanded definitions really helps be able to, I guess, analyze the law a little bit better. So how does this affect you? If you're a donor, this could really change in the process of how you direct grants. There's impacts on tax benefits and strategies for that charitable giving. For charities, the fact that they're going to have some clarification on how long money can sit in a donor advised funds. This really could potentially increase the speed of funding. And also will adjust on how charities interact with donor advised funds. For those that sponsor the funds, there's going to be administrative adjustments in order to comply with the new rules of the new regulations. And there could be some potential operational financial impacts, obviously. So these proposed regulations were actually released in November of 2023. There's a lot of good information and clarification within them. These are the first, but not the last. There should be, and they're talking that there should be more proposed regulations revolving around donor advised funds. We can rely on this proposed regulation, but we don't have to rely on this and can still analyze the law the way we want. But it is a great feature for us to be able to use for donor advised funds. So moving on to NIL, which is name, image, and likeness. So what is NIL for those that don't know? The definition is rights associated with a person's name, image, and likeness, particularly in the context of marketing and endorsements. So this is, you'll see this a lot with athletes and public figures. It's been around for a long time, but it got a lot larger and more noticeable in 2021 when the NCAA suspended its rules on prohibiting athletes from receiving compensation for their NIL rights. So this change allowed college athletes to sign endorsements, receive sponsorships, etc. And being in a state that we do have some larger universities, we've definitely had some of our clients run into situations with NIL. So there is some NIL organizations that have previously already received exempt status, but now that it's become a bigger deal once the NCAA passed that, the IRS in June of 2023 did come out with a GLAM, which is a general legal advice memorandum, really addressing whether the operation of an NIL is exempt purpose under a 501c3. And the GLAM stated that the activities are typically not exempt. They're serving a private interest of student athletes. And as we all know, charities need to, serve the public, not the private interest of one type of person. So tax implications of NIL, it's the GLAM stated they're not a charity in most cases. NIL payments are generally considered taxable income and must be reported on tax returns. Individuals may deduct certain business related expenses to that NIL income. An example on how this affects charities. I know we had a client who was approached by an NIL organization prior to that NIL organization receiving its exempt status. And the organization wanted clearly to use some of these athletes to bring donors and bring people to events for the charity, which is great, but they wanted all the payments to run through the charity and then 70 to 80% of those donations to go back out to the athletes. And that really doesn't do our exempt org justice when they're supposed to be serving the entire public versus, a specific set of student athletes. So but it was very gray area. And so this GLAM really allows us to say, okay, that's not how we're going to do this. So I only have one slide on this, but I just want you to be aware if you're an exempt org and you run into a situation like this. So employee retention credits. So some news came out this month. I mean, obviously ERC credits have been around for a bit now, but August 9th of this month, the IRS stated they will start processing about 50,000 low-risk ERC claims. There was kind of a halt on the processing, but now we're going to see an uptick in those low-risk ERC claims. So they project that the payments will begin in September, with additional payments going out in subsequent weeks. They will also start processing claims filed between September 14th, 2023 and January 31st of 2024. However, the agency has also released 28,000 disallowance letters to businesses whose claims showed a high risk of being incorrect. And I will note, I'm pretty sure the disallowance letters also do not tell you why you're being disallowed. So we do have a couple of clients that have received these, and we are ready to help. These can be appealed, so it's not a final determination. So if you do get any type of this disallowance letters, please reach out to us and we'd be happy to help. We've gotten a lot of questions on how to know if your ERC tax credit is being processed. You can try calling this 1-800 number and you can ask. A lot of times they will let you know if it's at least been assigned or if it's being processed. But if it's not in one of those areas, you're likely not going to get much more information than that. You'll just have to kind of wait and call back. Some other programs for the ERC is the Voluntary Disclosure Program. So this was announced in December of 2023, and there's a second program that's now running through November of 2024. This program really allows businesses to correct improper payments at a 15% discount and avoid future audits or penalties or interest. It's designed to help those businesses with questionable claims to self-correct and repay the credits they received after they've already filed an ERC claim in error. The IRS has posted, and there's a hyperlink here, so when you receive these slides, you'll get that. And I also have the website at the end of this presentation, but there's some warning signs from the newer application process and the older that they've kind of listed, about 12 of them, I think, for those higher risk ERC claims. A couple of those warning signs are the inability to support how the government order fully or partially suspended businesses, or the government order that maybe didn't apply. Businesses reporting family members' wages as qualified wages, using wages that were already used for the PPP forgiveness. You can't use them for both, so that's one of the issues. And then large employers claiming wages for employees who provided services. So make sure you take a little check on that, warning signs if yours is still sitting out there. Hopefully your ERC gets processed, but in the event it doesn't, or you get a disallowance, or if you feel like maybe it was done in error, you can always voluntarily disclose that. Now, the special withdrawal process, this was announced in October of 2023 for those that submitted an ERC claim but have not received a refund yet. So this is really for those organizations. If everybody knows, there's been a lot of ERC marketing schemes that came out and would tell organizations, hey, you're due to get this large ERC, and we want 25% of that or something to that sort. So anybody who maybe fell victim of that, this would be a great opportunity to withdraw from that process. Claims withdrawn will be treated as if they were never filed. The IRS will not impose penalties or interest on those. But there's a few things that you have to have in order to withdraw from the process. So you had to have made a claim on an adjusted employment tax return, like a 941. That return that you filed, the adjusted return, has to only be to claim an ERC credit and no other adjustments. You have to withdraw the entire amount of the credit, and the IRS cannot have already paid you for your claim. So just a tiny slide on energy credits. This is a very, very complex area, but I just wanted to put kind of a plug out there. For the first time, tax exempt orgs can claim certain energy credits, and these can be done on their federal income tax return, like a 990T, even if you have no tax liability. They do have direct pay options. My plug here is that if your organization is investing in anything that might be worth checking into on the energy credit side, please reach out to us. We do have someone here at the firm that can help guide through that process. It is a process that you need to kind of know ahead of time so you can make sure you have the right things in place. But if your organization is interested in this, please reach out. But I could talk or my expert at the firm could talk for hours and hours on this. So didn't want to get into too many details today. So some legislative updates. We have some expiring legislation coming at the end of 2025 that could affect charities or other, organizations that are getting donations. The three of them that I think affect the most are the standard deduction is scheduled to revert to previous levels. So this may increase taxpayers to take advantage of that charitable donation deduction. I mean, as we all know, the standard deduction increased and many people couldn't itemize anymore. Also, the doubling of the estate and gift tax exemption will be expiring, which will affect charitable requests. And also that 60% of AGI, I just saw CP pull up, so hopefully everybody got that. 60% of AGI limit on deductions for individuals for cash contributions will now drop back to 50% of AGI. Some of the other expiring legislation that to be aware of is that individual income tax rates could revert back to their 2017 levels. The cap on state and local tax deduction will dissolve. This could also allow more people to want to give charitably to increase their itemized deductions. And then also the qualified business income deduction of 20% for pass-through businesses will disappear. So some of these things could affect tax planning and whether individuals or businesses want to give charitably. Obviously, we have a lot of time between now and the end of 2025 and a lot of things going on this year. So that definitely, many of those could be reinstated. Some possible proposals. There could be a possible limit to private foundation distributions to donor advised funds. Could exclude private foundation payments to disqualified persons from qualifying distributions. Applying an ordinary income tax rates to capital gains for high income taxpayers. Possible non-itemizer charitable deduction. We have had this in the past, so it might come back. And a possible increase in charitable mileage rate, which I know a lot of people would prefer since the mileage rate, it would go to the business mileage rate, which would be great for those people giving charitable miles. And here are just some websites that I listed for the ERC credit claim if you want to withdraw, or some of those warning signs of incorrect ERC claims. And that is it for me. I'm going to stop sharing and I'm going to introduce Amber, who is going to continue the conversation in the tax area. Thanks, Amber.
Can you see my slide?
Yes.
Perfect. So thank you, Brandy. So again, I'm Amber Rathbun. I'm a senior manager in Maner's tax department. I have been with the firm for 10 years, and I do spend most of my time working with our nonprofit clients. And so today I will be talking about prominent worker issues. And so there are a handful of topics that I do want to cover today. So it will be pretty high level, but I do just, want to give you some awareness and some best practices in these areas. So first, we'll talk about employee versus independent contractor classifications. We'll touch on volunteers, remote workers, expense reimbursements, and compensation of insiders and excess compensation. So diving into employee versus independent contractor classifications. So this is an issue at the federal and state levels. So in general, the government is going to want workers to be classified as employees, and nonprofits and maybe even the individuals, workers themselves, may want to be classified as independent contractors. And so the government tends to pick on this area, and the reason for that is it's an easy revenue generator. So the penalties for misclassifying workers is severe, and it is difficult to get those penalties waived. There is some hope that if the IRS disagrees on classification, but you do have contemporaneous documentation of your position, then penalties are much less likely to be imposed. So the classification is really going to be largely facts and circumstances. Just checking on the chat. Sorry, it doesn't apply to me. So enter your questions in the chat if you have any. So facts and circumstances is going to be the approach. There isn't going to be a true, just what we call bright line where one factor, makes a worker one or the other, employee or independent contractor. So the nonprofit does want to take a reasonable position and contemporaneously document that position. So again, document. Ideally, you want to document at the time the worker is hired. So you're documenting that position. You do want to retain that documentation, and that will be helpful in the event that there is a federal or state audit. Now, this doesn't need to be complex. You really just want to list out the facts that you're basing your determination on. And if this wasn't done at the time of hiring, it is recommended to go back and do this for your workers. And then the presenter at the AICPA conference did mention that a written agreement is not enough. It's not, there's not much value to be held there. And my understanding is that the facts and circumstances are really going to play the largest role. So if a worker, they use the term quacks like a duck, if the worker is having all these factors that point to an employee, they're going to be an employee, even if the written agreement may say independent contractor. So there is a 20-factor test, and the IRS has now kind of broken that down into 3 categories of control. So it's not necessary to pass all 20 of the tests, but a majority is helpful. And so the 3 categories are behavioral, financial, and type of relationship. I did list a resource here, which is an IRS publication, 1779. It's not one of those publications where you pull it up and it's 100 pages long. It really is truly a 1-page brochure, so that may be helpful to you if you want to take a peek at that. Just want to mention that perceptions do matter. So if we're looking at the right-hand side of the slide, some of the questions you want to be asking when you're determining the classification is, is the organization providing detailed instructions on how the worker is going to perform the work? So are they dictating when, where, what tools they're going to use, who they should hire as assistants, and then who is providing the tools? Is the worker coming with their own tools of the trade, or is the organization providing those tools? Is the organization providing training or benefits such as paid vacation or disability insurance, which would point towards employee classification? Another interesting one is the worker given an organization email address? Not on the slide, but is the worker representing themselves as being part of the organization? Is the worker, performing services for other entities, or are they only working for your organization? And then a couple other things to think about. are, what's the time period? Are they performing work for you just for a project, or could this agreement carry on indefinitely? And then how are they being paid? Are they being paid by the project, or are they receiving a monthly compensation amount? So two things I did want to highlight from the conference. There were two things mentioned that you should avoid, if at all possible. The first one of those being issuing a 1099 and a W-2 to the same worker in the same calendar year. So now sometimes there are circumstances where a worker could switch from one to the other. And so you, of course, want to document that and the reasoning why, their classification is changing. But if possible, avoid issuing both of those forms because that could trigger an audit. Another, thing to try to avoid is classifying the workers that's different from how a majority of other nonprofits are classifying the same type of worker. So if you're diverging from that standard, that's something you also want to avoid. Let's see if I had any other items. I think I covered everything there. So moving on to volunteers. This ties back into the worker classification issue. You want to make sure your volunteers are truly volunteers. So let's see. A government regulator may want to come in and say that you're not reporting compensation or you're under reporting compensation. And, this is getting pretty nitpicky, but a government regulator may try to argue that T-shirts or meals given to volunteers are compensation. Now, keep in mind the presenter at the conference does deal a lot with California. So in reality, really what you want to be looking for is the volunteer being given a fair market value, being compensated the $600 1099 reporting threshold. Another thing to look out for is if an organization is trying to recruit volunteers and tying their hours to an incentive-based program like points or benefits, maybe paying some student loan payments, that is going to point to compensation. Then when we're thinking about cash and gift cards, those are compensation. So keep that in mind. And then a little bit of a unique scenario. Let's say a trip was donated to the organization and the organization gives that trip to a volunteer. Just because the organization didn't have any cost related to that trip is still compensation to the recipient. So just something to keep in mind. Looking just a little bit at remote workers, you want to make sure if you do have workers that are in other states that you're making sure you set up payroll where the workers are physically located. And then checking for any corporate registration that may be required in the states where the workers are physically located. You want to check for rules outside of payroll. So one of the examples given was if a worker is conducting an activity that is producing unrelated business income. So unrelated business income is outside of the scope of this session, but that's going to be a trade or business that's regularly carried on and it's not substantially related to the organization's mission or exempt purpose. And so those items or those activities are reported on 990T. Moving along into expense reimbursements. So first and foremost, before you actually reimburse expenses, you do want to make sure that you're getting an expense report and receipts if applicable. Generally, we should not be reimbursing independent contractors. And then, on the right-hand side, adequate accounting does include the date, the time, the place, the amount, those items are going to be covered on a receipt, but then describing the business purpose of that expenditure. Tying back into remote workers, you would want to document if you're reimbursing for business assets, that you're documenting that those assets are, the organization's business assets and specifying that the use is for business only. Keep in mind that commuting is generally a personal expense and it's not generally reimbursable. So when you do have, out of area, out of state remote workers that are traveling and you're reimbursing travel expenses, make sure that the policy is documented and that those do have a business purpose. And then biggest takeaway, other than making sure you get an expense report before reimbursing expenses, would be to have an accountable plan. If you don't have an accountable plan, then reimbursements, even if they do have a business purpose, then do become taxable to the recipient. So for an accountable plan, these are allowances or reimbursements paid to employees for job-related expenses, and are excluded from wages and not subject to withholding. So it's an allowance or reimbursement policy, and it does not necessarily have to be a written plan, but it's considered an accountable plan if, one, there's a business connection to the expenditure, two, and we're at CP poll number 2, so make sure you click yes to the poll if you need CPE. Let me get that out of my screen. So one, business connection. Two, there's adequate accounting by the recipient within a reasonable period of time. So not, 6 months after the expense occurred. And then if applicable, excess reimbursements or advances are returned within a reasonable period of time. So we know what an accountable plan is now, not necessarily written, but having those 3 requirements. What is a non-accountable plan? It's any program or policy, regarding reimbursement that does not meet those 3 requirements of an accountable plan. I'm going to move into compensation of insiders. So first, we want to define who is an insider. An insider is going to be a person, an individual in a position that could potentially unfairly benefit from the resources of the organization. So this could be in the form of excessive compensation. So really the resources of the organization are meant to go towards the organization's exempt purpose and not supposed to be benefiting, individuals. So we're looking at excessive compensation here. The insiders are going to include officers, directors, key employees, the family members of officers, directors, key employees, or a business that an insider or multiple insiders own more than 35% of. So why does this matter? As I mentioned, the nonprofit is not supposed to be, benefiting private interests. So we hear, private benefit, we hear the term private inurement, and this is important because you can risk losing tax exempt status. We may have to take corrective measures and may be subject to penalties. So I do want to talk about rebuttable presumption. So there are 3 requirements that if they are met, then the compensation is presumed to be reasonable, and this shifts the burden of proof to the IRS to prove otherwise. So the 3 requirements that need to be met are on the right-hand side of the slide here. So it's board review and approval, comparability analysis, and documenting the process. So getting into those a little bit more specifically, the compensation arrangement should be approved in advance by the board. And this should be composed of individuals who do not have a conflict of interest regarding the transaction. So the person in question of the compensation, whether it's reasonable or not, should not be, in the room approving that. And then prior to the determination, the board should obtain and rely upon appropriate data as to comparability. And then lastly, the board adequately and documented the basis for its determination concurrently with making that determination. So as part of the documentation, it should include the terms of the transaction, the date of the approval, who was present during the debate and vote on the transaction, the comparability data that was relied upon, action of any members who do have a conflict of interest, and then just overall documentation of the basis for the determination. So really important for organizations that are, compensating board members, officers, that you are covering these three requirements, doing the due diligence so that the burden then shifts to the IRS to prove that compensation is not reasonable. And then so, this is only one slide touching on section 4960, which was a little hard to put together, but I just want to cover this. So when we're looking at excess compensation, section 4960, this is applicable tax exempt organization or a related organization that pays remuneration in excess of 1 million or any excess parachute payment to a covered employee. This is going to be subject to an excise tax. So the excise tax is going to be on the excess amount, and that rate is going to be 21%. So on the right-hand side, I tried to, show you that in this section 4960, there's a few definitions that we need to know. Remuneration is going to start with box 1 W-2 wages. So this is a little different than what's typically reported on the 990, which usually starts with the higher of box 1 or 5. So it is nice that, this remuneration, fancy word for compensation, is starting with box 1. And then there are additions and subtractions to that amount. One of the additions is going to be purely a timing difference. So if a bonus was earned and vested during the calendar year, but not yet paid out as of 12/31, that is going to be an addition, so that a bonus not included on the W-2, but it was earned in that calendar period. And then a subtraction is going to be designated Roth contributions. There are more additions or subtractions, but just to give you an example. And then what is an excess parachute payment? So when we're thinking about a parachute payment, this is going to be an individual that was terminated, given a severance payout that was 3 times more than their base compensation. And this does not have a $1 million threshold. This can be under $1 million, but we're really looking at that 3 times base amount. And so then, of course, throughout this slide, we're talking about the excess amount. And then who is a covered employee? Section 4960. So when we're thinking of covered employee, we want to be tracking the top 5 highest paid employees each tax year, because a covered employee is the top 5 of the tax year, or it's someone who was a covered employee in a preceding tax year. And for the preceding tax years, that's after 12/31/2016. As you'll see going back on the left hand of the slide, 4960 is effective as of 12/31/17. As I've kind of alluded to, it is based on calendar compensation. So if your organization is operating on a fiscal basis, we are looking at calendar compensation for purposes of this section. Just be aware too of compensation from related entities. If the organization is compensating an individual and they're also receiving a large amount of compensation from a related entity, it may, if they're over the $1 million mark, it may be that each entity needs to pay their share of the applicable excise tax. There could be a situation where you just need to document why 4960 doesn't apply. Example that was given at the conference is if an individual is compensated over $1 million by a related governmental entity who is a volunteer board member for the reporting organization. The reporting organization just needs to document why the section doesn't apply. And then this excise tax is reported on Form 4720. And just know that wages to a medical professional, which includes veterinary services, are excluded from 4960. So that is all that I wanted to cover today. And then I'm going to switch it over to Abby. I believe I stopped sharing. Yes, thank you.
Okay. Am I sharing my screen okay?
Looks good to me.
Perfect. Thank you. So thank you to Brandy and Amber. They give us a great overview of some tax rules and regulations and updates. We're going to switch focus now and talk about reserves. some cash on hand reserves and investments. We're really only going to be touching the tip of the iceberg here. There's lots to consider, lots to think about when it comes to investing, but we will be talking through a few things. We're going to define reserves and their importance. We're going to review some industry data and highlight some of the struggles that nonprofits are facing right now with cash and reserves. And we're going to talk through some areas of consideration for your organization and maybe some things to think about or look at going forward. We're going to start by just kind of taking a minute to think. What does your organization's dream state look like in the future? So just kind of think about that. Long-term, 5 years, 10 years, 15 years down the road, do you want to expand on current services? Are you wondering how you can take the things that you do really, really well today and do more of that in the future? Do you want to create new service lines or new offerings? Are there areas that you feel like your community is lacking? Do you want to build a nest egg for emergencies or a plan for future assets? The thought process behind reserves is really similar to personal finances. So for instance, I have children, they're fairly young. And so we are thinking now already about their future and potential schooling in the future. And in order to be able to afford that later on, we need to start building a nest egg or saving in reserves now. And so that's kind of what this is all about, is what are your long-term goals that and what do we need to be doing now to ensure that we can meet those long-term goals? One thing to note on that last slide that I meant to bring up is just how sometimes we don't get the opportunity to think about long-term strategic planning, because at a nonprofit, you typically wear 5 different hats and you are playing many different roles and living sort of in a emergency world, right? You're putting out fires constantly. And so taking some time to do some strategic planning and thinking for the future can really alleviate stress and have a lot of benefits. So what we're going to talk about right now is why organizations need reserves. So the key reasons and the importance. So bridging cash flow, because of course cash flow is it ebbs and flows, it goes up and down a lot. Maintaining financial solvency, weathering economic cycles, funding opportunities so they can be expected or unexpected. But it's nice to have reserves that when something comes up, you can say yes to, assuming it's something that's important and supports your mission. Certainly, unpredictable political environment that we're in right now. Another thing is just generating interest income to support operations. If you have the ability for your money to work for you, then it can help alleviate stress on operations if you're having a little bit of a down year. An entity with little to no reserves is oftentimes fluctuating on the brink of continuing or closing. And this creates a lot of stress. It creates a huge amount of stress for those running the organization. It also adds a lot of time on those overseeing the financials, because they have to closely monitor cash in order to pay bills and process payroll. One of the things that we're kind of seeing and is happening is there's sort of an increased rate of disruption being put on reserves. So there's increased competition right now, which it's sort of ironic to think about with nonprofits, but not necessarily that they're competing with each other, but they are sort of competing with the amount of money that can be donated or granted or gifted to their organizations. There's also technology changes and needs, the need to be more flexible. With COVID, I feel like every organization in the world has this increased need to be more flexible. There's also greater volatility. So previously, where you had a lot of engagement from constituents, that engagement may have decreased substantially. Where you used to have high attendance, that may not be the case anymore. So the need for reserves is it's very high. Now we're going to talk just for a few minutes about the nature of reserves. So in really easy terms, there's really just one way to get reserves. So it's generating surpluses over time and accumulating those surpluses over a period of time. Investments represent a portion of those reserves. So long-term reserves or long-term investments would represent a portion of that. And then you typically have sort of short-term reserves that would fulfill some of your short-term needs. And then we have operating reserves, which would be your cash on hand and things that are covering your operating expenses. The reserves that we're mostly talking about today are the non-operating cash investments. You need reserves for internal financing to avoid having to go out to the market to take on debt if something comes up. One challenge, though, for most nonprofits is that we tend to lack the expertise when it comes to investments. So the management and governance and the board don't typically have a lot of expertise when it comes to how to manage investments. So utilization of an investment advisor is very common for nonprofits, and it's recommended. What can be frustrating is it sort of feels like performance of our reserves are generally a little out of our control. So utilizing that expertise of an investment advisor is very smart. So I mentioned earlier that commonalities between personal finances and finances within an organization. So this is just putting things in really simple terms. But I assume most or all of us have a salary that we bring in. So that's the money, cash inflow for us as individuals. We then have expenses that are going out the door, house payment, car payment, childcare. And then the end result is what we have in our savings. And just like I talked about for reserves, we usually would have a short-term savings for vacations or gifting, some smaller dollar amounts with shorter time horizon. And then we have our long-term savings. So those are big things: college tuition in the future, retirement someday. So these are going to be bigger dollars, and they have a much larger or longer time horizon on them. So surplus equals savings if we're going to then correlate this back to an organization. So as an organization, you are also going to have savings in the form of surplus, and that can be in both a short-term and a long-term bucket. So the end game here is really sustainability. So the way that this was defined at the conference is the ability to carry out activities that will achieve your mission while developing and maintaining capacity for mission relevance in the future. We want to be relevant in the future. So I'm going to mention sustainability a number of times later on as well. So we need to make sure that we're planning and reserving for the future so that we can still exist when that time comes. We want to be relevant in our communities because we know what a positive impact we make in our communities, and we want to make sure that we can continue to make that impact into the future. So sustainability is huge. Okay, we're going to switch gears just a little bit and kind of talk through just the state of the industry, what's happening in the nonprofit world right now, what are some of the things that we're seeing, and you'll see that a lot of that's going to tie right back to this conversation about reserves. So it's never been more important than now to find ways to monitor financial health of our organizations. There was a 2018 analysis done, and it found that 7 to 8% of nonprofits are considered insolvent, meaning that their liabilities exceed their assets. 30% faced liquidity issues with minimal or no cash reserves and very few short-term assets. 50% have less than 1 month of operating reserves. So there are a few things driving this need to continuously monitor your financial health, such as the speed of changes that are happening in just our environment today, technology changes, the way people connect and how that's morphed over the years. And then another key component is the shifting of demographics. It's caused a shifting of value proposition. So with a donor, a member, a grantee, the end user, or the community that we serve, their values and needs have shifted. The way we do events used to be in person. A lot of times things have moved virtual or partially virtual. The way that we do publications used to be a lot of paper, and now that's gone more to e-publications or email communications. The way people donate has shifted. So being able to shift along with those things and ensure that you continue to have strong financial stability is key. you need to be able to take all these various changes that are happening in our environment and data points and connect them ultimately to your financial information and ensure that you can maintain financial health ongoing. There was a survey done in 2022 by the Nonprofit Finance Fund. It surveyed 1,200 respondents from 47 states. 12% of those had less than $100,000 of annual expenses, and 7% were greater than $20 million. I just bring that up so you know that there's big disparity in the size amongst the respondents, but it doesn't seem to be too heavily weighted one way or another. When looking at this graph on the right, the cash on hand, I'm going to kind of talk about it in three different buckets. So the first three lines, bottom. So the bottom three lines, the smallest, less than 1 month, 1 month, and 2 months of cash adds up to about 23%. The next bucket is the 3 months of cash, 4 months of cash, and 5 months of cash, and that adds up to about 32%. And these two groups, I would estimate, are in a position of continuing or attempting to build reserves. So they have less than 6 months of cash on hand, and they need to continue to think through how to build that and to be more sustainable and living a little bit less in the day-to-day. We talk with various organizations about having 1 month or 3 months of cash on hand to help cover operating expenses, and that's an okay spot to be. It's not necessarily as comfortable as a lot of organizations want to be, though. So usually an organization with less than 3 months of cash on hand has a goal of getting up to 5 or 6 months of cash on hand. And many are working to get to that point. The last group, so the top two buckets, 6 months of cash and then greater, is 45% of organizations within this survey. And these organizations are at a place where they can analyze their risks and opportunities and make real decisions about those. They need to determine if 6 months of cash on hand aligns and reflects with what they need in reserve. So does that match up with what their long-term goals are? They need to consider shifting out of cash on hand and reserves and into some more longer-term investments, possibly. Utilizing things in a more strategic way and ensuring that their money is working for them. Another piece of this same survey asked about what the top three financial challenges are that organizations were facing. You'll see that the highest three lines here are raising unrestricted revenue, raising funds that cover full costs, and achieving long-term financial sustainability. So obviously a key theme that interconnects each of these is cash reserves. I want to talk through, just a reminder, our end game is sustainability, of course, and we want to be relevant to carry out our mission. But kind of getting in the way of that are a couple of common misconceptions. So a lot of people feel that maybe the IRS doesn't even allow nonprofits to make a profit, or that if a nonprofit has a lot in reserves, that maybe they're hoarding donor funds or not utilizing them in the way that they should. Or that nonprofits with a lot of cash don't need more funds. And those are all things that we kind of work to debunk and talk about. We want to address these in a proactive way on the front end. So talking to your governance structure, your members, and your community, and communicating with them about sustainability. Talk about your long-term goals, your growth, your mission, your relevance, and discussing the need to have successful reserves in order to maintain that sustainability and continue to move forward in your mission. So another quick thinking moment here, we sort of talked about at the beginning, of course, what our dream future state looks like. But what are the key risks now that are preventing you from achieving that dream future state? Knowing those risks is going to obviously help you address them head on so that you can continue moving forward and getting to a place where you are closer to that future state. This slide is really busy, but this graph, I think, can help us talk through a couple of different things, and it helps a little bit visually represent some of the items that I was talking about. So it's broken up into two main sections, operations on the left and then non-operating reserves and investments on the right. We've mainly been focusing on the non-operating reserves and investments in the right buckets on the right. But if we just really quickly talk through operations, thinking through your current programs, things that you'll want to be thinking about are what economic changes in your business lines are you expecting to see over the next several of years? Does it make sense to keep those current programs? How do we need to morph them to continue to be successful? When looking at future initiatives, what are the assumptions about investments, upfront investments in order to take on a future initiative? Ongoing expenses, and then expected revenue. Is a new future initiative going to be able to fund itself? Will they be able to generate a surplus that then can feed into these non-operating reserves and investments? You'll see under that category, there's the short-term holdings and the long-term portfolio. We talked about that when thinking through personal finances as well. So your short-term holdings and reserves, multiple things can happen with this. So if this bucket gets too large, you can either utilize it to help fund operations during a time in cash lull in your operations, or you can use it to move into your long-term investment portfolio. So there are a lot of questions and strategic planning and thinking that comes along with these two buckets over here in the non-operating reserve section. The things that you kind of need to figure out is how much of your reserves and investment portfolio should you deploy to fund operations? How often do you need to do that? One way to actually help with that is a cash flow analysis. This is something we do regularly with our clients, but knowing throughout a year, and usually you want to look at multiple years, when in the year are you going to have large cash inflows and large cash outflows. That can help you plan how much to keep in cash on hand, how much to have in short-term holdings, how much to have in long-term holdings. How much of reserves is a correct amount? Where's that sweet spot? That's going to look different for every organization. You'll also need to kind of figure out how are you going to deploy those reserves, and how do you decide how to deploy them? What type of data do you need in order to make those decisions? What amount of risk tolerance do you have within your organization? There are tools to help you navigate these questions. So the key things are your reserve policy and your investment policy. Some organizations are large enough to have a specified investment committee. And so your investment committee can really help you review and update these policies, ensure that those policies are robust enough and that they're in line with that dream state we talked about in the very first slide. You want to make sure that you're heading in the direction that strategically long-term you want to be. I mentioned at the beginning that we're sort of really just going to be getting the tip of the iceberg with this reserve discussion. There's so much more involved. One of the things, just really quickly, I'm going to touch on, of course, is that there's a lot of in-depth conversations that you could have about investment risk and tolerance. Again, working with an investment advisor, we have some experts here at Maner who can help with those things. We also have folks who can help review these reserve and investment policies. And to really just help facilitate those conversations to ensure, again, that you're meeting those long-term dream state goals. And the other thing is that within each of these categories, reserves and the investment pool, the long-term investment pool, usually you would have a number of funds within those. So it's not represented here in this graph, but you could have a fund that focuses mainly on sustaining, to enabling you to withstand any economic downturns internally or externally. You could have a fund that's focused on infrastructure, so maintaining funds that are going to help with major technology and facility needs to ensure that you're staying on top of or ahead of some of those drastic technology changes that we're seeing right now. And then maybe you have one for excellence and innovation, something to fund new opportunities and new ideas. So again, that's not represented here on this chart, but that's something to be thinking about, that you can have those opportunities. So we have talked in conclusion, we've defined reserves and their importance. We've reviewed some industry data and talked through some of those struggles. And then we sort of talked through some considerations for your organization going forward. Any questions?
Before you wrap up, are there times when utilizing short-term debt makes more sense than pulling from reserves or a long-term investment?
Yeah, good question. So, first of all, always work with your investment advisor when talking through things like that. They're going to really be able to answer that for you. But a lot of nonprofits have cash that's very cyclical. So if you think of an association, they might receive all of their dues. So maybe they receive 70% of their cash just in one time of the year, and that cash has to last them the entire rest of the year. So a lot of entities have a line of credit or some type of short-term loan that you can take out. Obviously, if you have reserves, you don't have to do that. You don't have to utilize that line of credit. You can pull from your reserves, but sometimes there are opportunities where maybe the interest rate on your line of credit is less than what you're earning in reserves. And those are the conversations that you would want to have with your financial advisor. So definitely talk through things before you make those types of decisions. But yeah. You're muted, Brandy. I'm going to pass it off to Kyle now.
Hey, Abby, real quick, before that, we did have a question. I think Brandy was on mute. So there, one of the questions is that these are lofty ideas for a small local nonprofit. So where do we even start?
Yeah, so I mean, that's a great question. Even as a small nonprofit, I mean, you still have the need and the desire for reserves. Like I said, anything that we talked about today can be scaled to a large organization or a small organization. Even small nonprofits don't want to be managing cash on a day-to-day basis. So you still can have long-term 5-year, 10-year, 15-year goals. And it is still beneficial even for a small nonprofit to have reserve policies and investment policies that line up with those goals. So for a small nonprofit, I would see if you even have reserve and investment policies. And if don't, that could be something to consider and to get started. And then maybe to just have a meeting to talk through some strategic planning of where do we want to be in the next couple of years, and to make sure that those policies line up with that, and to see how your current reserve status is going to help get you to that point. Hope that helps.
Thanks, Abby.
All right, Kyle, do you want to take over?
I got it. Looks like we've got our fourth CPE poll popping up. So I'll get my slides up. Feel free to answer. All righty. Good morning, everybody. I'm Kyle Schafer. I am on our nonprofit services team, and I work on our assurance or audit services team. So as far as what I'll cover today, will be kind of focused from audit and accounting side of things. The nonprofit conference put on by the AICPA was a great conference held back in June. Just kind of thinking through all the content that was shared and available. You know, it was a 3-day conference, 4 different tracks between tax, audit, uniform guidance, and CFO level individuals. So when you just kind of think through all that content and time and effort, trying to narrow things down to, you know, an hour and a half presentation, you know, for our team. So what we'll probably do or try to do is, you know, have some takeaways for everybody, at least, you know, food for thought for upcoming discussions with your Maner team or relationship manager. But as far as today, talk through from the single audit side of things. So obviously coming through from the perspective as Maner as auditors. And so from the uniform guidance standpoint, you know, kind of open playbook or compliance audit. So things to be aware of or what's changed. Uniform guidance, there are some upcoming changes later this year for the next fiscal year 25 and after. And then we'll do a couple of recap items from accounting updates as it relates to GAAP or generally accepted accounting principles. There have been a lot of updates over the last couple of years. So hopefully, you know, everyone sees, you know, a little bit of a break or a breather as far as, you know, the adoption of standards. And then the lease standard was most recently implemented for many organizations, you know, a year plus ago. So not talking through the implementation side of things, but just kind of the newer other things to consider post-implementation. Alrighty, so talking through the single audit side of things, this will be talking through the 2024 compliance supplement. This was issued just a few months ago, and this will be for fiscal years starting after June 30, 2023. So a lot of June year ends, so your fiscal year 24 would be applicable there. We do have a link of just where you can find the compliance supplement. The single PDF's available. It's 1,000+ pages, so you can also see at that link where there's a couple of appendixes that I'll go through if that's easier to digest or go through as items are applicable for you. So as far as a couple suggested starting points, we talked through the supplement as a whole. For the most part, it's continuing to be less detailed, more prescriptive, if you will, so things that are higher level in nature for the most part. And then there's also in the appendix talking about what changed from year to year. But you can always reach out to your Maner team member. We've got a handful of individuals that had a chance to kind of run through as soon as the compliance supplement was posted in May, just going back through 23, 24. And that way giving you a heads up as far as what compliance requirements may have changed or what may be new or other things like that. So as far as just a quick reminder from an auditee perspective, it's been for a few years now. We switched from a compliance requirements where it was switched to a Pick 6 model. So typically 6 direct material compliance requirements to be tested. And so that's made things a little bit easier from a directionality standpoint, from an auditee standpoint, except for a couple of the clusters where there are some exceptions for those compliance requirements. But for the most part, things that are easy to point out, anything that changed from a yes to a no from applicability or direct material, and then any new programs are identified as new or deleted. And so a lot of times when there are changes such as that, added or removed, it's basically, based on the kind of volume or frequency of those programs being audited. So a lot of times if you see some of your programs that might not be in the compliance supplement, it may be a large dollar amount, but across the US, maybe it's not as significant as some other programs, such as ones coming through the Department of Ed or Department of Health and Human Services. This compliance requirement in Part 3, it's been around for a couple of years now, but hopefully give you a little bit from a context standpoint if some of your Maner team members might be asking about it from a procurement side of things, the Build America, Buy America Act. So some of our questions from as far as your procurement goes, is it outlined as specific provisions or preferences in agreement, or if they're applicable waivers obtained? And so that's just giving you a little bit from a perspective standpoint where the nature of some of those questions might come from if you have procurement as an applicable audit area for your programs. In the appendix number 4, just a quick refresh is some higher risk programs. So as far as COVID era funding, some of that has, dropped off the cliff, if you will, or others have kind of, dried up. And so there are a few that have fallen off, which I'll show on the next page, but these would be for your fiscal year June 30, 2024 and after through the next year identified as higher risk programs. And so these would be, if they're identified as a high risk A, they're required to be tested. And so common ones that you may have seen for your organization would be the emergency rental assistance or the Corona state and local fiscal recovery funds, both of those coming through Treasury. And so we've had a lot of associations that maybe hadn't received federal funds historically, had some opportunities for grants that lined up with their mission so they could help impact either those served by their organization or those in their community served. So as far as a couple of the programs that have been removed on our education services outside of a lot of our nonprofits, Education Stabilization Fund was audited a ton for calendar or fiscal year 23. So that's removed from the higher risk designation. The other one that would be popular or commonly tested would be the Provider Relief Fund. So no longer identified as higher risk, going through the normal risk assessment from our auditor standpoint. Moving on to Appendix 7, just other heads up as it relates to things to be aware of from an auditee perspective. Also sharing a little bit from a context standpoint. If you continue to have Maner or someone from our team reaching out on that data collection form filing, we're not asking about your car's extended warranty, but there is a why behind trying to make sure things are trying to get finalized timely. And so there are two items to be aware of from an auditee standpoint. The 9-month filing deadline. So as of, if you're a calendar year end, you have until September 30 to have your audit submitted to the Federal Audit Clearinghouse. But the other caveat there is the shorter of. So if your audit is finalized, you have 30 days to get that submitted. And so as soon as we have that management representation letter in hand, we're working on our team to make sure that can be filed timely, working through both, the auditor and auditee certification. And so hopefully that gives a little bit of a context as far as, why we might be pushing to make sure that you can stay in that low risk auditee standpoint. If you don't meet those criteria, you're automatically pushed up into that high risk or not low risk auditee classification. Sticking with the data collection form, still on the Appendix 7, some of you or many of you have noticed on the data collection form, the process was slightly different, or the form or some of the information on the clearinghouse is in a different format or requested differently. That was related to the transition previously on the Census Bureau. And so that was a big project. It was delayed a couple times. And so pretty much everybody that has been submitted, since October of 23 has been on the new site. So a lot of the fiscal year end and calendar year end entities, fiscal year for 23 and after, some of that looked a little bit different. And so as far as kind of going forward this year, shouldn't be any changes and should be kind of in line with what you're used to seeing from this last year. Next, I'll cover a couple of the uniform guidance revisions into the next section. Just one reminder as far as your CFA and data collection form goes, anything that was funded with COVID-19 money up above when you saw the Medicaid cluster where that was part of the existing funding, or other programs where that was new funding that's continued to be required. But again, that should fall off in future years. As far as the uniform guidance goes, so Part 2 CFR 200, these will be a few things that we'll also, in addition to today's presentation, we'll send out in our Keeping Posted email blast to summarize some of these key points for everyone. But just a few takeaways we'll talk through from the auditor side of things, which also impacts the auditee, and then we'll talk through the auditee side of things as it relates to compliance and your federal policies and procedures from a compliance standpoint. So as far as the audit threshold, that is increasing from $750,000 to $1 million. If you think back, previously it was $500,000 and $750,000 and now $1 million. And so it does reduce the number of audits required for organizations. That's not super impactful when you think of the entire US. It's anticipated to be 4,000 to 5,000 fewer uniform guidance audits being conducted on an annual basis. In addition, your aid program threshold changes. What previously when you're over 25 million, now that's over $34 million. So again, just working with your Maner team as far as some of that risk assessment goes. Thinking through the auditee side of things, we've got a few items. We won't hit on all of them, but like I said, this will be out in an email blast. Changes to the indirect cost rate. So if you don't have a NICA rate, you rely on some of the allowed de minimis cost that has increased from 10 to 15%. The other items to point out would be the bottom of the page or near the bottom when we're talking about equipment and supply threshold. That's doubled from 5,000 to 10,000. So things to be updated or incorporate into your policies and procedures. The other item of note, which is new and there is not yet a framework outline for it, is on the bottom right where we're talking about requirements for cybersecurity measures. And so as more guidance is rolled out in that area, we'll continue to communicate that to our team members and to our clients to make sure everyone's kind of same understanding from an expectation standpoint. As far as takeaways for today, when we're talking through the uniform guidance revisions, when does it go into effect? That'll be for fiscal year ends starting October 1, 2024. So coming up in just a few months. So like I said, great opportunity to get a chance to meet with your Maner team member, go through your federal policies and procedures, look through grant agreements. And so a lot of these items cannot be early adopted and will be applicable to fiscal year 2025 and later. There are a few items that in the transition period, waiting on the Office of Management and Budget or OMB to issue guidance. So as that information becomes available or is issued, we'll be sure to share that with everybody. Also related to timing, you may have some grants crossing fiscal years, so just making sure that you're communicating with the resource provider or agency to make sure we're following the correct time frame or applicable guidance, during that transition period. So once you get it post-transition or after your fiscal year 25, it'll all be under the new guidance. We'll do a little bit from a GAAP update. So if you think back through recent years, there's been at least one significant or major accounting standard update for most nonprofit organizations. The most significant one a few years back was the not-for-profit reporting model. And you think through revenue recognition and contribution accounting clarification. That was also pretty impactful for most organizations. Contributions of non-financial assets, formerly the gift in kind or in-kind contributions, some clarifications to that standard recently. The lease standard, that was good from an overall presentation and disclosure, helping from a comparability standpoint. If you had leases, typically you'd have to go all the way and find which footnote those were presented in. So having a little bit more comparability for nonprofits when you look at organizations that may own their property and equipment compared to leasing. So helpful from that side of things. And we'll touch on time permits a little bit from a lease items for consideration. Most recently, everyone that's probably calendar year through a fiscal year June has had a chance to go through or implement the credit loss standard. I'll spend a little bit of time there just as far as refresh and making sure everyone's comfortable for their organizations for what might be in scope or out of scope from that side of things. So as far as kind of a GAAP update goes, your calendar year 2024, quick pause, CPE poll number 5 is up on screen now for everyone. As far as the GAAP update goes, like I said, relatively calm for 2025. And then as far as kind of what's coming down the pike, there are some, not enough that would be broadly applicable to organizations on today's call or for auditors on the call. But as ones that are applicable to your organization, your relationship manager will be sure to kind of touch base or at least make sure they're being considered for significant accounting policy updates or changes. So some of these items were takeaways from the FASB's side of things. So one of the big items, like I mentioned, was on the lease standard. And so a lot of organizations that we worked with, we helped with a calculation that was built in Excel, not super complex, but worked well from anywhere from 1 to 20 or 30 leases. Some of our larger nonprofits that maybe had some complexities might have used a lease software, but those are things that are not just kind of a one and done. That'll be part of kind of either your monthly, quarterly, or year-end accounting going forward as those leases are applicable. There is an issue that we can chat through with your team members on the risk-free rate, doing it by asset class rather than each individual lease. Hopefully allows for some streamlining of recording lease categories. Excuse me. So as far as CECL or the credit loss standard goes, just a quick reminder as far as what's in scope and what's not in scope. So as far as what's not in scope, contributions. So you think of different terms or words for contribution, possibly pledges, promises to give, grants, if you account for them as non-exchange transactions. Those are all scoped out and not applicable to the standard. Things such as loans or debt issued that's accounted for at fair value, that is also scoped out. If your organization had loans and debt that's at amortized cost, we would have had conversation over the last 2 years, as that is very impactful from beginning balance, recording some things that were not previously recorded. So for the most part, this will be a kind of high level. I have a couple examples to cover as well, but just making sure that you're good on a go forward basis or post implementation, making sure that if there's any updates that you need to do for your financial statement users or management decisions, those are all being reflected on a ongoing basis. So as far as the credit loss standard, just a quick refresh. When you're thinking of things that you're recording for dues members, for associations that might be on the call, or program services that were exchange transactions, accounts receivable recorded at amortized cost. Pretty much your past practice typically would have been it's receivable until it's not. So the incurred loss model. And so now under the new credit loss standards, intending to be more forecasting or looking forward. And so a lot of that can start from a fairly easy standpoint, and we'll talk through that. So a lot of our associations, we've got a example to kind of run through there. But basically, looking at where you've been from a historic standpoint and realizing that not all, revenues or receivables are going to be 100% collected. And that way that's kind of reflected throughout the course of the year rather than, as something fails to perform or fails to be collected. So we'll talk through just a few items, like I mentioned, as far as historical information. That is a great starting point for organizations. So looking at current conditions, we'll go through, like I mentioned, on the receivable side of things. Sometimes it might be good to look at what types of revenue streams, where those customers have been, or pools of your types of customers, depending on if they're maybe a governmental agency, business, individual. That way you can kind of disaggregate the information for good decision making. So as far as just a quick example to run through, make sure we're keeping everybody on time. When we're talking through the membership dues, a lot of times if you're thinking through, if your members are individuals, there's probably a higher challenge for your association trying to collect those dues. A lot of times on the businesses, the invoice comes in and it's paid a little bit more timely. There might be some laggards. But as far as, just looking through this example, here's kind of where they've been historically on the collection rate for their dues over aging buckets. And so just kind of looking through what that looks like, we do have many associations that, they'll run their AR, aged AR at month end or quarter end and just kind of look how that compares and apply a credit loss estimate or bad debt expense. GAAP doesn't prescribe a bad debt or credit loss terminology. So you're thinking back on your financial statements, a lot of our recommended enhancements were credit loss, just to make sure, draws the reader attention for the adopted standard. But there is some, diversity in naming convention there. But this is just one example as far as, where the loss rate was historically, improved conditions, improved forecasts by about 10%. So previously what the credit loss rates were used, improve those or reduce those rates by 10%. And so just a simple calc of, looking forward of where you're expecting things to trend, you'll have a smaller credit loss or possibly recover on your expense or gain or loss side of things. A few items to hit through on the lease side of things. Like I mentioned, I'm not going to go back through the adoption on things, but really things when you're kind of on a go forward post implementation, where we see most on the nonprofit side of things, organizations being creative in their spaces. Sometimes you'll have a below market rate, which we'll start with rent, or maybe 100% donated or dollar leases. And so, if you didn't have that organization or resource provider providing those spaces, you'd otherwise have to go find, what that fair market value would be. And so we'll kind of talk through both ends of that, both being below market rate rents. And so there's two components to that actually. So you'll have, the lease portion, and then you'll also have an in-kind contribution. In this instance, when you think through non-financial assets or in-kind contributions, a lot of times, you're consuming and expending those resources at the same time. In a situation like this where there's donated space, there'll be a different timing or recognition for when that contribution is recognized to when that lease expense occurs. And so just to kind of keep in mind, that impact or things to communicate with, your directors, executive team, and stakeholders or financial statement users. So just a quick example that we'll run through. We'll do kind of, the initial day one and then kind of give you on screen what it looks like for a lease term. And so the part that's pretty similar that you would have had in the past is recording the lease contract portion. So what your actual having to pay or cash outflows. In this case, it's $120,000 a year for a multi-year lease, and the fair market value would have been over $2 million. And so you've got the normal item or the typical item from the lease contract, your right of use asset, your lease liability, and then your lease prepayment, that payment due at the beginning of the year. The part that's nuanced or kind of outside the norm from your lease accounting is you're booking a multi-year promise to give or contribution receivable. And because it is multi-years restricted for those future periods, it is a donor restricted contribution. And so you can see that on screen here. Then when you kind of see how that plays out, if you look at this, you can see, this covers both the below market rent. If you're thinking that you have, or for your organization that you don't have below market, but it's a dollar or zero, you just chop off this top half where there's a lease piece. And so you'll still have that lease expense. You can see where that's being expensed straight line basis over the lease term, which is different on the timing of that receivable and revenue that you booked upfront on that contribution. Just a few more minutes, and then we'll have any other questions or comments from those on the call. The other item to be aware of for existing leases is terminology, or what you need to do from an accounting standpoint for any terminations or modifications. And so for the most part, if everything's kind of, as implemented, you're just rolling forward your schedule, making your payments, sometimes adjusting either monthly or annual basis as far as your right of use asset and long-term and short-term lease liabilities. But there might be instances that maybe you've left a space, you've been able to negotiate and terminate a lease, or maybe there's a modification. So on the termination, that's pretty straightforward. At the point in time in which that occurs, you're removing your right of use asset, you're removing your long and short-term lease obligations, and that difference is going to be the gain or loss recognized on. Skip down to the modifications. We've got a quick flow chart just to kind of help with that decision-making process. And so starting, does that, give an additional right of use asset? If so, basically treat that as a lease separate from the original contract or agreement. If it does not, does it reduce the scope either through a full or partial termination? And so some of that might be reduced payments or change in lease classification. So depending on those will impact on whether you're recording a gain or loss for a partial change, or if that'll be just an adjustment to your right of use asset and related liabilities. So as far as just things to think about, not diving too deep into, but just making sure things to be aware of for conversations ahead with, throughout the course of the year. So things that might be modifications, if there's anything, like I mentioned, that might be in addition to additional square footage or additional space, so basically a separate contract. If there's a change in lease term, thinking about the ability to exercise at the beginning, if you had, additional 5 or 10 or something like that years that you've now decided we are going to exercise, or maybe a change in the purchase option reassessment. Maybe at the time when you made the decision or implemented the lease, you weren't certain what you would do from a purchase standpoint, and economic conditions have changed or been more favorable to change that decision. So quick summary as far as that remeasurement of your right of use asset and related lease obligations. You can see from a graph standpoint on which ones result in a remeasurement, updates to your discount rate, where we talked about using the risk-free rate if there's not an incremental borrowing rate available, and then if it results in a lease classification. So with that, hopefully a high enough level for everybody, hopefully, and happy to answer any questions. And if not, turn it back over to Brandy.
We have one question. So for the uniform guidance updates, when should our organization plan to update our federal policies and procedures?
Oh, great question. So like I mentioned, that'll be coming through a couple reminders coming up, one in our September keeping posted email blast. And I might have kind of glanced over on the slides, apologies there, but that'll be for fiscal years starting after October 1, 2024. So if you're a September year-end entity, that'll be good to work through from a planning standpoint. Like I mentioned, just if you work with, Maner on any of those, just reach out as far as making sure that you've got those updates to your federal policies and procedures, ideally as close to the start of the year rather than mid or after the applicable fiscal year. So great question. And then quick heads up, there's polling number 6 on screen.
Thank you, Kyle. And thank you to all of our presenters today. Thank you for everybody for joining us. We will be emailing out a recording of this presentation along with the slide decks early next week. So look out for that. And then hope you have our contact information will also be in that email if you need to get a hold of us for any reason or any questions you might have after you've finished this. And have a great day. Thank you, everyone.